Um, Members, good evening once again. So we want to actually have a look at our question, because that is where we stopped. Last time when we met, we stopped at this very item. We were actually trying to describe this one, say that this is our break-even point, where the total revenue curve crosses the total cost curve. We actually said this is a break-even point. So we said that margin angle of incidence is just around here. Yeah, that's where the angle of incidence lies. Then margin of safety, it is a difference between the current level of activity and break-even activity, whereby the current level of activity is 80%, then the break-even activity is 30%. This one could be expressed in units or in shillings and etc. I know you are observing SOPs. Please wear masks and sanitize and keep a social distance, because we really want your lives. We still want you are most important citizens of tomorrow. So now today, let us actually have a look at this very, so that was a curve, but now this time want to express it in figures and see what happens. We have this very illustrative example whereby saying that the following standard cost statement relate to a product which sells 100,000 per ton, and these are the costs which are expected to be which are expected to be incurred, or which have been incurred in producing some units of output. So units of output, we have them here, 3,000. So to produce 3,000, then a manufacturing entity would actually incur direct materials of 30,000, direct wages of 20,000, variable overheads of 10,000, total variable costs here 60,000. Alongside, the manufacturing entity also incurred fixed overhead, so fixed costs of 20,000. So total costs is 80, 60 plus 20, because we know that total costs are equivalent to fixed costs plus variable costs. Then here we are actually requested, in other words, after incurring all these total costs, then a production of 3,000 units. These are 3,000 tons. We can call them tons. These were the tons produced, and in producing 3,000 tons, 80,000 costs, 80,000 shillings costs were incurred. So now here you are actually required to compute, to calculate the break-even point, no graph required, calculate the contribution to sales ratio, calculate the margin of safety, calculate the percentage increase in profit if sales volume increased by 10%. Then calculate extra tons to be sold in order to maintain the existing level of profit if the selling price is reduced to 10%. So now, given this illustration, we can actually start computing. There are some things you need to take into account, and some things you should actually know. Which are these things? You must actually know that here we have fixed costs, we have variable costs, we have the selling price per unit. So now here break-even point in quantity, because this is part A of the question. It is part A. We want to compute that one and see. Part A of the question, the break-even point in what? In quantities. Break-even point in what? In quantities. So here the break-even point in quantity is equal to total fixed cost over the contribution. Whereby contribution is equal to what? Whereby the contribution is equal to selling price This is selling price, then minus variable costs. So in case they ask you to compute contribution, calculate contribution, then you know that it is unit selling price minus unit variable cost. So now, according to this very question of ours, according to our question, we have these important issues. We have fixed costs. We have these variable costs here. Then we have fixed costs here. An aggregate of the two is 80,000, which is the total cost. So now to compute, since this very break-even point in quantity requires us to have a look at this formula, that it is fixed costs, break-even point here is equal to total fixed costs over contribution. So now, fixed costs, we have 20,000. Our 20,000 is here. This is the one. This is our 20,000 for fixed costs. This one. Then from there we have our variable costs here. Our variable costs here 60,000, which is this one. These are our variable costs. A combination of this 30,000 plus 20 plus 10,000. Then our selling price. Our selling price here is this one. This is selling price because I said the following standard cost statement relate to a product which sells 100,000 per ton. So this is a unit selling price per what? Per ton. Then here, given all that, we need or we want to compute what we call the break-even point, whereby now here the break-even point will be equivalent to here we are given total fixed costs, whereby our total fixed costs and please remember we must actually know that much as those are the total fixed costs, but we have units of output. This is the most important thing. The most important thing which should these units which were actually produced. Given such costs after incurring those costs. So now when you talk of total fixed costs, then it means we shall actually be looking at a fixed cost per unit times the number of units produced. Okay? Yeah. So now here we can have a short break and we come and compute our break-even point. Let's have a short break, then we come and compute our break-even point.